Hey, good morning, guys. Good morning, Eric. Is your microphone on? Check your microphone, Eric. Can't hear you. There's nothing. Sorav, are you there, Sorav? Sorav? All right. I see only two people here. Let's see how many people are in today's forum. Oh, there are more people here. At least I see 5 people in the in discussion board. And let's see, I see 4 people here. Oh, okay. Good morning, everyone.
Good morning, Professor.
Hey, good morning, Samira. Okay, Eric says microphone is not working for some. Well, okay. Uh, try to fix it. Okay. I guess you gotta check your. Oh, that's my audio volume. Check microphone, right? Like make sure your microphone access is on like this. Anyway, so in our last class, the last thing we talked about in our last class was, oops, we were doing this example, right? And we found we got this, right? We solved for um, the price of the bond. And then next question was, what was the current yield? So I need to talk about the yield, right? So there are 2 types of yield, right? There are, I don't know why this isn't responding. It responds to my finger, but it doesn't respond to, okay. Pen. You all know that yield, what's going on? You all know yield is annualized return. Yield, it's the matter, it's my stylus, so let's see if I can. Basically, yield means annualized return, okay? Annual. But first, the problem was asking for current yield, and the current yield is annual coupon payment, right? Divided by the selling price of the bond. So annual coupon payment is nothing but our coupon payment is every 6 months, right? So every 6 month coupon payment times 2, so which is not a difficult thing. But why do we divide it by the selling price of the bond? Now think about it. Return is basically Return is basically output over input. Isn't it right? Return is basically what you get. In other words, for your investment, for your initial investment. So hard to write. For your initial investment, how much the output is for that initial investment. That's what the return is. And think about it. Your initial, if you want something from this bond, you have to buy the bond. So you have to pay this price, right? You have to pay the market price. And for that market price, and current means, short term, right? We all know current means short term. And short term, so what's the maximum of short term? The maximum of short term is 1 year. So basically, what you can get from this bond for holding it for 1 year, it's quite obvious. The maximum output or maximum proceeds, right? Maximum cash flow from holding this bond for 1 year is the annual coupon, right? Or 2 semi-annual coupons, right? That's the maximum you can get. So current yield is, in that sense, it's the short-term yield, right? It's the short-term yield. So according to that, and we did this in the annual coupon will be $80 because coupon rate is 8%, and currently the market price is this, right? So 80 divided by this, and there we have so I just want to make this some adjustment to this to fit our example, and our example was coupon rate 8%. How many years left? I believe it was 10 years, right? So change that to 8%, and then 10 years. And we did it last time. Payment over R minus payment over R times 1 plus R raised to N. Something's not right here, right? It's 80, H8 raised to N. Okay, yeah, I got that. And then, so that's only, for now, that's only the annuity part. So plus the face value, or 1 plus R is to N. And there you go. Oh, something's not right. Where did I go wrong? Payment over R minus payment over R times 1 plus R raised to N F8 plus face value 1 plus H8 over something's not right. What happened? cannot be. 1,000, 8%, 10 years. Oh, this was 10%. I'm sorry. This was 10%. Right. Okay, so that's the rational price. We call it, this is actually B, okay? But, everyone should, this is actually B. What is B? That's the rational price of the bond. So, so here's the thing. What is the difference between B and P sub B? And this is my notation. And I talked about this in the previous classes. This is rational price or intrinsic value. Intrinsic value or fair value. Intrinsic value or fair value. So what that means is this is the price that it should be, right? Versus this is the market price or selling price. So what's the difference? Look, so this market price is the price that it is, and it's the difference between what it should be and what it is. And think about it. I've been telling you over and over, market prices, most of the times, market price is not the correct price. Market price is, because market price is the result of demand and supply. And the demand and supply can be, the demand, first of all, the demand can be, there's a lot of psychological factor to demand, because, when there are a lot of noise in the market. Noise means, rumors and, misinformation and all of that. That's noise. And a lot of investors, without a lot of investors are just, I've been telling you over and over, average Joe, average Jane, and all these average Joe and average Jane don't know how to, don't know anything about valuation models. They don't know anything about the fundamental analysis. They don't know anything. They just buy the stock because someone tips them. Well, this is something that's going to be big. Just like, Donald Trump way, right? Donald Trump is so, infamous for the typical, swindler, a wheeler dealer, wile and guile, wheeler dealer, swindler style. Like the used car salesman, it's always like, I know a guy who knows another. I know a guy who knows a guy who knows another guy who knows another guy who knows another guy who can get you a great deal. That type of, wile and guile, right? And a lot of, market participants are easily wiled and guiled by rumors and noises like that. So in other words, the choices that average Joe and average Jane make are not the rational choices, but those are irrational choices. When they they see the prices go down, they panic and they also sell. And when the prices go up, without really trying to figure out why the price is going up and whether it is unfounded or not, without figuring that out, they just want to jump. They just want to jump into a bandwagon. In other words, herd mentality. Market in the short run is um, swayed so much by the that herd mentality. Okay, that's what is happening in the short run. So market price, that's market price. Market price is determined by that herd mentality and irrationality, whereas uh, rational price is strictly based on the rational expectations. And what's the rational expectations about the bond, from the bond? Think about it. Bond is quite obvious. In case of stock, there can be a lot of noise, but relatively compared to stock, bonds, there is hardly little noise. There's little noise. Why? Because it's the cash flow. The cash flow expected from the bond is quite obvious. There's nothing. There's nothing unexpected, or there's nothing unknown. Cash flow from the bond is coupon payment. What else can it be? There's nothing else. No room for, and think about it. There's no capital gains or unexpected capital gains or capital loss in case of bond. In case of stock, there can be unexpected capital loss and capital gains, but in case of bond, capital gains, capital loss is quite obvious. Think about it. In the life of the bond, over the life of the bond, um, so this is the timeline, okay? So this is the maturity here, time zero. Think about it. There are only two types of bonds. I mean, three types. One, you might say, oh, treasury, corporate bond, and municipal. No, I'm not talking about that. I'm talking about whether. Think about the price. Is the price selling above the par value or selling below the par value? You all know if the price at time zero or at any point, if the price is above the par value, then that's called premium bond, right? That's called premium bond. And think about it. Over the life of the premium bond, over the life of the bond, the price will eventually decline like this. Isn't it right? Because no matter where the price was at time zero or at whatever point, as time approaches maturity, as we approach maturity, the price will be close to, price will also approach 1,000, the face value. Isn't that right? The price will eventually and on the day of the maturity, the price will be exactly $1,000, right? So you will see this declining pattern over the in the in the price of the premium bond. And on the other hand, if the bond is a discount bond, let's say it was sold at this discount from $1,000, and over the life of the bond, it will eventually, right? Over the life of the bond, it will eventually approach the face value of 1,000. Right? Is everyone following?
Yes.
Okay, at least one person. How about the other people? What's happening? I have only how many people? 6? This is ridiculous. This class has like on the roster 25, but those who are tagging along, those who are, 7 people here. So you think I'm not checking who's in and who's not in? I do, not only by this, but also in the I cannot show you that now, but if I go to you see, if I go to collaborate sessions, all previous sessions. So for example, April 14th, there were 7 people. And by the end, April 5th, there were still 13 people. And then you see, I can see who joined the session at what time and at what time they left, right? So, I mean, people who stayed logged in, 1 hour 43 minutes, 1 hour 44 minutes. It's clear that those people stayed there the whole time. But someone like Eric Malave, too bad. I mean, this cannot be. And this person, Randall Roach, he cannot be recognized as, a full attendance, right? Only 47 minutes logged in only. And then this person joined, once this got disconnected and joined again. Of course, I can't, and total time that's good enough. I would say this is okay. But, I can't go over this every day, of course, but if I suspect that some person is just playing a hooky, just, log in, but, never participate in class, then I can check. And the only reason I don't look at this is because it's not in alphabetical order. I need this to be in alphabetical order so I can compare it with the roster. That's why I only selectively do this, check this, when I have a suspicion that some people are playing a hooky. But that doesn't mean, you can take advantage of that, right? Reynolds, yeah, always don't forget to do the, do this. This is your proof of attendance. Okay, you have to do. I mean, that's for your own. It's like establishing your own alibi, right? Own proof of presence, right? Alibi is, let's say, someone says, you were not there. You were not there. You were not present. And how would you prove? No, you cannot. Word of mouth is nothing. What do you think word of mouth? What kind of weight word of mouth carries? And this is common sense, but somehow a lot of people believe. Yeah, it's an L. But a lot of people believe that if they say I didn't do it, then they think their word of mouth carries any weight. No, your word of mouth doesn't carry any weight. You have to have the proof and evidence. And if there was this, on news, there was this horrible homicide case, some woman who lived in in an apartment in Chinatown. I don't understand why she got an apartment in Chinatown. Maybe because it was cheap and Manhattan, it's downtown. But some homeless guy. I don't uh, he was probably uh, prison inmate, I mean convict, who because since the pandemic they released a lot of these people from Rikers Island, and they are on the street, and this guy stalked her, followed her to her apartment, and then killed her, and then the next day he got caught, and on the camera he was all caught in the camera in the hallway of the apartment. So there is the proof. There's a smoking gun. But he still said, no, I didn't do anything. I didn't kill anybody. That's very typical of this, that was just about, 2 months ago. I believe it was in February. You're all caught, these guys are all caught on camera, and they think their word of mouth is worth something. So always think about that. You need to create your own. I mean, of course, I'm not saying you are committing any crime. All I'm saying is that leave your digital footprint. If you are present, you got to leave your digital footprint. Okay? And this is like a badge of honor. I was there. Right? This is like your badge of honor. Proof of attendance, right? I've been telling you every time. All right, anyway. So back here, where was I? So think about it. So I know at least a couple of people are paying attention. I don't know about the other people. So this is the pattern of the cash flow. I mean, capital gains or capital loss. I mean, the other cash flow is the coupon payment. But as far as the price is concerned, this is the price you paid. If it is a premium bond, over the life of the bond, there will be capital loss. Over the life of the bond, there will be capital loss. And over the life of the bond, there will be capital gains if it was originally a discount bond. Okay, this pattern is quite obvious, right? So but as I said, this is only my notation. In my notation, I make this distinction. So this is the rational price. In other words, the price that it should be, not not average Joe and average Jane's, the price that was determined by the demand and supply, which is based on average Joe and average Jane's whim, right? Which was swayed by the noise. Whereas P sub B is the average Joe and average Jane's, price. The price that is, determined by the demand and supply. And as I said, in case of stock, there can be a huge difference between the rational price and the selling price, the market price. But in case of bond, that discrepancy, that difference would be very small, because in case of bond, the cash flow is quite expected. I mean, cash flow is clearly expected. I mean, coupon payment, and then capital gains or capital loss. There's no other ad hoc factor. There's no other. There's no there's no unknown variable, and there's no ad hoc. In other words, uh, not an unexpected or everything is routine. In case of bond, everything is routine. Cash flow is basically by routine schedule, and it's routine, so no ad hoc factor. Okay, so therefore the difference cannot be that much. The difference is very minor. They are pretty much close, but still there can be difference. So that brings us to the discussion of, brings us back to the discussion of yield. So short-term yield, current yield is the short-term yield, but then suppose this is 10 years, right? This timeline, let's say this timeline is 10 years, or 30 years, whatever. And if it is 10 years, okay, if it is 30 years, this is 10, 20, 30, right? 5, 15, 25. I mean, from time zero, every year, right? If you buy this bond and hold it for 30 years, if you buy this bond at time zero and hold it for 30 years, what is the annual return? What is the annualized return? In other words, annually, what's your return, right? That's called yield to maturity, right? So yield to maturity is the long-term yield if you hold it to maturity. So yield to maturity can, suppose you buy this bond at this time zero, and assuming that you are going to hold it for 30 years, then that's what that yield to maturity with 30 years left, and the yield to maturity with 10 years left. Let's say you bought this bond at this point, then there are 20 years left, and the yield to maturity at that point would be different from yield to maturity at time zero. And suppose you bought it at this point, then only 10 years left, right? There's only 10 years left. And the yield to maturity at that point would be different from yield to maturity from this point, or, or from this point, right? Of course, yield to maturity would change. And I would say the yield to maturity would be greater at this point than at the other points, at later points. Why? But so at some point it will reverse. Why? Because look at this. If you have a lot of, if the coupon rate is, think about it. If the coupon rate is high, like 10% coupon rate, if the coupon rate is, if the coupon rate is something like 10%, high coupon rate, then look at this. You have 30 coupons, annual coupons, but bond is semi-annual. Bond is on semi-annual cycle. So that's $50 or 5% every 6 months, and 60 of them. Annually, it's $100, 30 of them. You have a lot of coupons left, $100 coupons left, right? You have 30 of them left. And the present value of that would be greater. I mean, by this time, think about it. You have only 10 coupons left. So the present value of that would be smaller than the present value of, 30 coupons of $100, right? So most likely the yield will be the highest at this point, but it will change over time. So yield to maturity is the long-term yield. Okay. But another interpretation of yield to maturity is this. Again, This is the mathematical interpretation of yield to maturity. So you know what this is. That's the rational price of the bond, and we know what to do with that. It's, formula is payment over R minus payment over R times 1 plus R raised to N plus face value 1 plus R raised to N. Okay? And then if I write it this way, with PB on the left-hand side, I will have to use a slightly different notation, slightly different symbol there. Now, I don't know why this stylus is doing this to me. Okay, then you might wonder, what's the difference? I mean, aren't they the same formula? Aren't they the same formula? Yes, they are the same formula, but then the unknown is different, right? The unknown is, mathematically, the unknown is what you are solving for, right? But think about it. In the first equation, right? This is the unknown, isn't that right? Why? So far we've been trying to solve for the bond price, and because so the bond price is the unknown, but then everything else is known. This is known, R is given, right? Because in the problem, other bonds, comparable bonds are paying 6%, or the bond is priced to yield 6%. And in other words, this is known. It's not the unknown. Known. N is also known, right? R is known, N is known, payment is known, everything is known, right? And the left-hand side of the equation is the unknown, so we are solving for it. But in the second equation, market price is known. Isn't that right? Because market price is what you just look up, right? In other words, even today, right? Oh, we are having a bad time again today. Let's see. Yesterday they, made a turnaround. Oh, I guess this is today, 11 a. From the okay, this is as of now, I guess. Well, the Asian market has done well today. Asian market's done well. Europe is still in trading, and then other than FTSE, which is UK, not doing well. And in the US market, NASDAQ lost 3 points. This is, I'm heavily invested in NASDAQ, and from the highest point, I've lost, like about 11%. The highest point was sometime around November last year, I believe. The highest point was like December, November of last year. And since then, I've lost, almost, like 11%. But this is crazy. But anyway, you can look up the prices. You can look up real time because market price is the literally the result of the market transaction, right? Result of the trading. Um, so market price is known. Again, Jesus, payment is known, N is known, and if and then what is the unknown? The unknown is this, right? Y is the unknown, which means given this price currently, given the current market price, what should be the discount rate that would make the right-hand side of the equation, equal to the left-hand side. Okay, so the unknown y here is called internal rate of return. Internal rate of return. What does that mean? Internal rate of return is the mathematical term for that rate that makes the right-hand side of the equation equal to the left-hand side. And of course, there can be only one value that can satisfy this equal sign, right? Any other value would make the right-hand side greater or the left-hand side greater. So there's only one number that can make the left-hand side equal to the right-hand side. And that's called internal rate of return. Okay, so if you're solving for this y, right, and then that y I don't know why it's so difficult. That's why is it acting up like that today? That times 2 is the yield to maturity. Isn't that right? Because that's half your rate. If you multiply it by 2, that's the yield to maturity. And there's a reason why I use, lowercase y for that. Because it's the half of yield to maturity. Okay? So mathematically, that's, what yield is, long-term, yield to maturity. So here, let's do this exercise. I want you to open this, okay? You have this file, you downloaded this file last time and we worked on, so do you have this file in front of you?
Yes.
Okay, at least one person. What about the other people? Do you guys have this file in front of you?
Yes, Professor.
Okay, who was that? I don't see the microphone. Brianna, are you there, Brianna? Do you have this file in front of you? Eric, are you there, Eric? I think you're the one with the, okay, you have, Louis, you have this file in front of you, right? And Eric, do you have this file in front of you? I think it was Eric that said microphone isn't working. Now, Reynolds, you have this file in front of you, Reynolds. Okay, good, good. And Sorav, you have this file in front of you, Sorav? Okay, good. Ukba, you have this file in front of you, Ukba? Okay, good. Zachariah, you have this file in front of you, Zachariah? Zachariah? I guess we don't have Zechariah anymore with us, sadly. Okay, so those who have this file in front of you, first, let's do this first. Current yield it was this previous problem, and you see, if you did this with me, you have it there. If you didn't, do this now. And I told you this is actually B, the rational price or the intrinsic value, but also in equilibrium, right? And the reason I'm saying it is also PB is because in case of bond, there's very little room for the discrepancy between the market price and the rational price. Okay, and also in equilibrium, if we assume that there's an equilibrium in the price in this bond, if the price is in equilibrium, right, then it is the basically rational price. It will be the rational price. I mean, if when there is oversupply or over demand, I mean, if there is more over demand, then the price will shoot up. But once the price rises above the level where there's no more incentive and to demand this, then the price will come down. And think about it. The reason for over demand is because there is a room for making profit, which means undervalued. If, in other words, if the stock is or the bond is undervalued, right, or anything undervalued, if there's anything undervalued, right, then there is a room for making profit, right? So then everyone, as long as everyone who knows that this thing is undervalued, everyone will run to buy that. That demand pushes up the price. But once as the price goes up, then this gap of undervaluation, underpricing, closes. Once this gap closes, then there's no more reason, no more incentive for the demand to right. So and at that point, then there's no more underpricing, right? The price is back to its rational price. Okay, and vice versa. When there is a vice versa, when there is under demand, right? So in equilibrium, right, or in the long run, everything will be back at equilibrium. So that's why. I mean, this one was the reason I can write PB like here, right? Meaning, rational price is almost equal to market price. That's, so that's the reason. And so here, current yield is not a difficult thing. First of all, current yield is basically, annual coupon payment, right? So it's 2 times the, semi-annual coupon payment, and we divide it by the, market price. There you go. Current yield is 9.14. And now we're gonna find yield to maturity. But it's the time is now what? 11:51. So I guess this is a good time to take a break. So we'll take a 10-minute break and reconvene at like 12:01 or 12:02. And we're gonna do this example. Okay? All righty. So let's take a 10-minute. All right, we're back. We're back. So where was I? So okay, this example. Let's think about. Okay, I think that was an example of in the slide. Okay, if you go to the we'll have to come back to we'll come back to coal bond later, but let's go to this types of yield. You know, current yield, yield to maturity, and here we have this example here. Okay, it's the same example. So in this example, the price, this is the price, market price, but you know, I specifically, it's the same thing, P sub B or P sub M, the same thing. So let's take a look at this example. And you might wonder, why is it like $100? I mean, first thing you notice, so here, we bring it down here, right? So row 22. Can face value be $100? Huh? I mean, something's not right. Face value $100? No, actually, this is $1,000. But why is it listed as $100? You know, this is maybe I better remove the dollar sign. Let's say just number, not the dollar sign, just the number. Here too. Just a number without the dollar sign. Now, what is this? If you remember, the first thing we did, when we entered the bond valuation topic, right? The first thing you saw was, you know, how the bond prices are quoted in the news media, in the print media. And what you saw there was, what is this? Did I tell you, does anyone remember? I told you that the bond prices are quoted as the percentage of the par value. Do you remember that? Bond prices are quoted as the percentage of the par value. So this 91.735 is not $91, but that means $917.35. Do you guys remember that? Hello? Anyone there?
Yeah.
Okay, at least Sorev and Brianna. Okay, Sorev, do you have a question? I mean, is it why you raised your hand?
No, I do not have a question, Professor.
Okay, all right. Just wanted to say that you were there. Okay, all righty. So, so the first thing we did was basically where am I? You know, that the bond prices are quoted as percentage of the par value. So that's what it is, right? In this example, the prices are expressed as the percentage of the par value. So that's the par value. So 100%, which is 1,000. And if you take a close look, you would see that row 22 is exactly the duplicate of row 15. In row 15, it's in dollars, but here everything is in, so instead of, so in the example, the price was the market price, right? Market price is given. And let me go back to, so this is 96.28%. Not dollars, right? So the price was given, so I'm gonna enter 962.8. That's the dollar price. Okay, then here it will, because I scaled it down. And originally I had it like this, negative. Okay, then this should be positive. Okay, and then we're gonna use yield command to find, and to do this, we will have to have everything expressed in, prices expressed in percentage of the par value. T0, that's today's date. In this example, it was 2013. Doesn't matter. We can, and 4 years left to maturity. I can change it to today's date. And this one, but look into that. This one is tied to this. So I want to change this date. I will have to change this date, right? I'm not going to change only this. I will have to. So today is what? 4/26, right? (2022), and everything will. This is 4 years later. This is 15 years later, right? I already have built-in, E22 times 365. You have to do it by 365. Because computer's calendar recognizes time by date. So in other words, 4 years later, I cannot just add 4 to that, because computer will recognize it as 4 days, not 4 years. So I have to multiply it by 365. So once this is done, let's do this. If you go to Excel's function, right, and then whatever comes up is most recently used. But if you, you need to go into the financial. If you go into the financial, right, go to yield, and it's in alphabetical order. If you scroll down, yeah, you will find yield, right? Are you all doing this with me?
Yes.
Are you doing this with me? Okay. So then select yield. Just one person, always just one person. Now settlement, that means settlement date. Settlement date is today's date. What is settlement? Settlement means, suppose you buy this bond today. When you buy something, you have to settle the account, right? You have to settle the account. That means you have to make payment. You have to pay. You have to bring that transaction to closure. And then once you bring that transaction to closure, then your account is settled. Okay? So settlement date. Maturity means maturity date. This is the maturity. You enter it like this. Rate means coupon rate. This is the coupon rate. You enter it. This is price. This is price. This is the price, right? And then redemption means, yeah, we know face value, par value, maturity value, redemption value, right? Enter that. Frequency, we know what frequency is. This is the frequency, okay? And as you enter that, you see something here, right? Hit OK, you got 4.53. That's the yield to maturity with 4 years left, okay? Now, we can do the same thing by doing it this way. But in this case, we will find the half-year rate first. We will have to find the periodic rate, which is the internal rate of return in this case. This is exactly the same example, right? You can see that this is exactly the same example. 1,000, 3.5% coupon rate. So coupon payment is 1750, right? 4 years left. You cannot use yield to maturity. You cannot use yield command, because to use yield command, you have to have these two extra columns: settlement date and maturity date, and then everything must be expressed as percentage. All the prices must be expressed as percentage. Again, this one, not dollars, but I'll have to, okay. So here, first we need to do this first. Okay, so actually this is the yellow highlight. This is the drab. Now we know what to do. You know, I mean, if this is normally, you know, we go to Excel's built-in function and rate. We look for rate. Hit OK. Give it what it's asking for. N. This is N. Payment. This is the payment. Present value. This is the present value. And you must understand why this is in parentheses. Parentheses means negative, but this doesn't mean really negative. I've been telling you, if you want to use financial calculator, I mean, basically Excel's built-in function is financial calculator. You must make distinction between cash outflow and cash inflow. And think about it. If you buy this bond, you have to pay this price. So that's cash outflow. That's why it is, you know, negative. And then at maturity, the face value is cash inflow. Every 6 months, coupon payment is cash inflow. They are all positive. So if you don't make this distinction between cash inflow and cash outflow, it doesn't work. It's not good. And the future value, this is the future value. Type, it's ordinary annuity. Bond is ordinary annuity, right? By default, so you don't have to put anything there. Hit OK. You got 2.2. If this is half year rate, full year rate will be this times 2, right? And there you go, 4.53. Okay, the same result, right? If you arrived at the same result, that's it. You're good. You're okay. Now, so since we are already, you know, here, let's do this. This is finding the price, right, by using price command. Okay, we've done pretty much everything. By using price command. So to do this, we go to a function. In financial, you go scroll down to find price. There's price. And once again, if to use this function, right, you will need to have this layout. All the prices expressed as the percentage and the percentage of the face value, and you must have settlement date and maturity date. So first, settlement, you enter settlement date. And then maturity, you enter maturity date. And the rate is always the coupon rate. Coupon rate. Yield, this is yield, right? It was given. Redemption value, this is the redemption. There you go. Scroll down. Frequency, this is the frequency. There you go. It's showing you something already. You hit OK. This is not dollars, of course. That's 90. And 90.51, which is $905.10. Okay. And the related problem. So everyone got this right? Everyone got it right?
Yes.
Oh, just one person. How about the other people? Okay, Louis, you got it right. And what about the other people? Did you all get it right? Should I take it as only 2 people? It's better than nothing. It's better than none, but you should do this with me. You should work it out with me, right? At the same time. Otherwise, doing it alone, of course, the recording will be there. The recording of this session will be there later today. But you can, if you try to retrace it, you can still do it by trying. But then, if you have a question, you don't have a recourse. If you have a question, now you can ask me, right? See, we got that there. So finally, let's do this example. This one is finding yield to maturity. Again, to do it this way, we'll have to solve for the periodic rate first. This will have to be and we know already what to do, right? So I'm not going to do this again because all you need to do is, if you've done this right, you can copy this, paste it here, right? But rather than doing that, let's do this. You remember this example? This example was from table 9.2, which is, why is this so difficult today? It's really, really, you remember at the beginning when we did this, right? I told you this example was taken around 2010, about June of 2010. How did I get it? I solved for n. So using this corporate bond example, 91.735. So 91.735, right? Which is $917.35. We'll first figure out the coupon was like coupon payment was $40, was it? 7%. Coupon was 7% actually. So if the coupon was 7%, 0.07, and then coupon payment would be this times this by 2. Where did this come from? 8 point, it was given, right? It was given. 8.38. So that was all given. Yeah, 8.38. Okay, so to make it exactly like that scenario, right? Where did I? So I don't know where I got this from, but we'll figure it out later. Okay. So given yield to maturity of 8.838, right, and half your rate is this, we can figure out what n will be, right? And from that example, maturity was May of 2016. So I plugged in there. Let's figure out what's going to be the n. Let's figure out what's the n. So again, this should have been the yellow. This should have been the drab. Oh, what happened? So we know how to solve for n, right? We'll just use, there's formula, but we'll just use, Excel's built-in function. N periods, hit OK. Rate, give it this rate, right? Periodic rate. Payment, this is the payment. And then present value, this is the present value. Future value, this is the future value. Type, of course, just ordinary, so nothing to do. Here we have something here. That's 11.71 semesters. We turn it into years, divided by this. This. 5.86 years. Some people wonder, what is 5.86 years? That's 5 years, and 12 months times 0.86 will give you how many months, right? So okay, and then think about it. Oh, so it's 5.86 years away from May of 2016. So today's date, then, in other words, when the bond price was like that, then this minus this times 365 will take you to June of 2010. Will take you June of 2010. So that's why I could tell you, that's why I knew this example was taken on June of 2010. Okay? And if we find, yield to maturity and internal rate of return, in other words, solving it, we'll get exactly this. Okay? So everyone got the same result? Do I need to keep asking?
Yes.
Okay,
Yeah, I
only
got
one
it.
person.
I got
Okay,
it.
two
I got
people.
something a little different, but I see what I did wrong. I did it
Okay,
wrong
so
formula.
okay, three people. So you got something. Who said something a little different? I guess you. These were given, right? These were
Mm-hmm.
given numbers, given input. So basically, solving for n, and make sure you have 7% here.
Oh,
If it is,
no, it was the
yeah,
other one.
because originally there was nothing there, and it was $40 a year, right?
Yeah.
So that wasn't exactly like, if you change this to $35, you will get exactly the same thing.
Yeah, I just fixed it. I see what I did wrong. It was the
Mhm.
formula. Thank you.
Mhm. All right. So this way we have covered everything in the bond valuation. Um, the only thing left is this, coal bond, and we don't have time to go over the coal bond today, so we're gonna talk about that um in the next class. Next class will be on Thursday, right? Take a look at this. So one example, um, how we can use the bond, investing in bond to maximize our return. So let's say uh, you anticipate long-term rates to change, to go down from 6 to 5.5% during next year. If the rate changes, so how do you know if the rate is going to go down? Well, because Federal Reserve, Federal Reserve always gives you the guidance. Constantly, they give you the guidance. What's the, I'm telling you, guidance is, whenever there is an FOMC meeting, after that they hold this press conference, and in the press conference they tell you what they're gonna do. And in March, right, they said they're gonna raise the rate by 0.25%, and they did. And then in May FOMC meeting, um, they are saying that they might raise the interest rate by 50 basis points, which means 0.5%. So, and the Federal Reserve is doing that every time. So you can pretty much, anticipate. Oh, and they said, there's going to be, like this year alone, there will be 6 interest rate hikes, and most likely, um, most likely they will do that. But because uh, raising interest rate by 6 times, it's like every time 2.5% times 6, it's going to be like 1.5% rate rise, which would be too drastic. So they may not really do that. By June or July, they will it will be more clear. See, they may not um, push through such a but if they say, the rate will go up, the Federal Reserve is going to raise interest rate by the end of the by 1% by the end of the year, most likely it will. So we can tell, and if we can anticipate the rate to go down, long-term rate means what? Not Fed funds rate or not T-bill rate, but Treasury note, long-term, right? Treasury note, Treasury, most of the times Treasury note, right? Um, it will go down by 0.5% during the next year. So what will be the total return for 20-year 6.5% coupon bond? So this is the coupon rate. Next year, this is going to be R next year. This is R this year. So then what's the price this year? Plugging it into the formula, you will get this. And of course, half year rate is 3%, right? You have N is 40 because, 40 semester. But then next year, think about it. This is half your coupon payment, right? $65, half of that. The rate will change to this, right? 5.5 divided by 2, right? And then because there will be 19 years left, meaning so 38 semesters. So what's going to happen? This is the price. So here, something weird is that, we can tell this is going to be a premium bond, right? Yes. Why? Of course, this coupon rate is greater than the discount rate, so it's going to be a premium bond, and it is. And it's going to be even more premium bond next year. So in other words, between this year and next year, there will be capital gains, right? And for 1 year, there is, a coupon interest of $65. So the total return from this holding this bond is 124, right? Because if you add these two numbers, 124. And so you divide it by the price you paid, right? Divided by the price you paid will be 11.74%. This is the holding period return. Now think about it. This is an interesting thing. Why? Because remember, over the life of the premium bond, I told you, over the life of the premium bond, this will be the pattern capital loss. If you have a premium bond, over the life of the bond, it will show overall trend will be capital loss, because by the end of the cycle, by the end of the term, it will have to be $1,000. But sometimes this is assuming that the yield, this is assuming that the yield to maturity doesn't change. This is assuming that yield to maturity is constant. But think about it. If the yield to maturity changes, in other words, the discount rate changes, even during the life of the premium bond, sometimes you can have something like this. And then, again, like this, and like this, right? But overall trend is, declining. Also the same thing, depending on, right? So, and think about it. Valuation means valuation of any asset is present value. Present value depends on the discount rate. Future value also depends on the interest rate, right? The interest rate is discount rate if you are talking about the present value. Present value depends on, So if the discount rate goes up, present value goes down, right? The discount rate goes down, present value goes. So in the years where interest rate is expected to drop, valuation, price of anything will go up. It's a good idea to buy the bond if this, stock too, if this is the case. Okay. All righty. So that's all the time we have. That's all the time we have. So basically, I'll have to call it a day. Have a great afternoon, everyone, and I will see you guys on Thursday. Any questions so far? Any questions? Okay, Lewis,
No,
have a
thank you,
great day.
Professor.
No questions. Okay, all righty. Then, I will stop recording and sign out. Okay, see you on Thursday. Okay, stop recording.